Let's move on to commercial mortgage-backed securities. There are quite a number of significant differences between commercial and residential mortgage-backed securities, and we shall discuss them in this lesson. Let's begin. Commercial mortgage-backed securities are backed by income-producing real estate. They're typically in the form of multifamily apartments, warehouses, shopping centres, office buildings, healthcare facilities, senior housing, and hotels. Like residential MBS, several commercial mortgages are pooled together and securitized as commercial MBS to be sold to investors. The CMBS investors act as lenders in this case. An important difference between residential and commercial MBS is that the borrowers who pay the mortgage obligations are the investors of the underlying properties. They rely on tenants and customers to provide the cash flow to repay the mortgage loan. CMBS mortgages are structured as non-recourse loans. This means that if there's a default, the lenders have no claim on the borrower's assets other than the collateral property itself. If the liquidation value of the property is insufficient to cover the outstanding loan, the lenders bear the shortfall loss. Compare this to residential mortgages where some of them are recourse loans. If a homeowner defaults, the lender has a claim on his assets if the amount recovered from the property is insufficient to cover the outstanding loan. For these reasons, the analysis of CMBS securities focuses on the credit risk of the property and not the credit risk of the borrower. There are two key ratios to assess the credit risk of a commercial property. The first is the debt-to-service coverage ratio, or DSC. DSC is a basic cash flow coverage ratio of the amount of cash flow from the property available to make debt service payments, known as the net operating income compared to the required debt service cost. The net operating income is defined as the rental income, reduced by cash operating expenses. A DSC ratio that exceeds 1.0 indicates that the cash flows from the property are sufficient to cover the debt service, while maintaining the property in its initial state of repair. This is desirable and crucial to getting a good credit rating. The higher the DSC ratio, the more likely that the borrower will be able to meet the debt servicing requirements. Conversely, if the DSC ratio is below 1.0, the cash flows from the property are insufficient to cover the debt service. The credit quality may suffer as a result. The point to note here is, a higher DSC ratio is better from the perspective of the lender. The other ratio is the loan-to-value ratio. This ratio compares the property's current mortgage amount to its current fair market or appraisal value. The lower this ratio, the more protection the mortgage lender has in making the loan. The LTV ratio reflects the amount of collateral available above the loan amount to provide a cushion to the lender. And the point here to note is, a lower LTV ratio is better from the perspective of the lender. So, let's say a rating agency has calculated the DSC and LTV ratios of this particular CMBS and determines that the levels do not meet the criteria for a desired rating. To overcome this, the issuer can structure the CMBS with subordinated tranches, such that the senior tranches can achieve the desired rating. Under this structure, losses due to default are first absorbed by the subordinated tranche with the lowest priority. Sometimes this most junior tranche is not rated and is referred to as the equity tranche, residual tranche, or first loss tranche. There are two characteristics that are specific to CMBS structures: call protection and balloon maturity provision. A call protection is equivalent to prepayment protection for an MBS. It protects the lenders from prepayment risk by placing restrictions on the early return of principal through prepayments. CMBS provide call protection in two ways: structural level call protection provided by the CMBS structure, and loan level call protection provided by the terms of the individual mortgages. Structural call protection is achieved when CMBS are structured to have sequential pay tranches by credit rating. The structure makes sure that the higher priority tranches are paid off first and retired before paying off the lower priority tranches. Also, losses from default hit the most junior tranches first before making their way to higher rated tranches. At the loan level, 4 mechanisms offer investors call protection. A prepayment lockout is a contractual agreement that prohibits any prepayments from the borrower during a specified period of time. Prepayment penalty points is a penalty fee expressed in points that may be charged to borrowers who choose to prepay. Each point is 1% of the principal amount prepaid. A yield maintenance charge, also called a make-whole charge, is a penalty paid by the borrower to make up the amount of interest lost by the lender as a result of the prepayment. It's designed to make the lender indifferent as to the timing of prepayments. And defeasance, accomplished by using the prepaid principal to purchase a portfolio of government securities that is sufficient to replicate the lost payments due to the prepayment. Given the high credit quality of government securities, defeased loans increase the credit quality of a CMBS loan pool. Besides call protection, the other unique characteristic of commercial MBS is the balloon maturity provision. Unlike residential mortgages, which are mainly fully amortizing loans where the principal is fully repaid by the end of the loan, many commercial property mortgages are typically amortized over a period longer than the loan term. For example, payments for a 6-year commercial mortgage may be determined based on a 10-year amortization schedule. At the end of the loan term, the loan will still have principal outstanding that needs to be paid. This amount is called a balloon payment. The risk of a borrower failing to make the balloon payment is known as balloon risk. When this happens, the borrower is in default. A borrower defaults if he is unable to refinance the loan or cannot sell the property to generate sufficient funds to pay off the outstanding principal balance. In such situations, the lender may be forced to extend the term of the loan during a workout period. Because the life of a loan is extended by the lender during the workout period, balloon risk is a type of extension risk for commercial MBS. And that concludes this lesson on commercial MBS. So far, we've been discussing asset-backed securities related to mortgages. We shall move on to non-mortgage-backed securities in the next lesson.